Hello everyone, and welcome to what looks like being a very exciting week in global financial markets as we get second quarter US GDP this week, we get PCE data for the US, and we get the wonderful Federal Reserve meeting where everyone is expecting interest rates to be raised for the very last time. But what people are probably underestimating, yes, you've heard it here before, is a very strident tightening bias to be maintained. The reason for this is, of course, in the background, but not central perhaps, but definitely in the background. We've seen wheat prices begin to rise again. We've seen oil trending higher for quite some time now, even gathering a little bit of pace. And we have natural gas prices beginning to spike again in Europe, and they're likely to do so in the United States also. So there's going to be some real inflationary pressure in the pipeline here that the Federal Reserve cannot ignore. And at the same time, while everyone loves to talk about headline inflation because it suits the argument that inflation is no longer a problem, the fact is, and really we all know it in the back of our minds, services inflation remains very, very strong. And in fact, core inflation hasn't retreated from its peaks at all and is in fact showing signs of reacceleration. In that environment, the Federal Reserve is hardly going to let go of those reins that it's been using to pull back on the US economy to stop the entrenchment of expectations on inflation among consumers, pulling back on the reins as hard as it can on the US economy, the most aggressive tightening cycle in the history of the Federal Reserve. It's not going to release those reins if we have this still strident core inflation and we have commodity prices, energy and food prices globally beginning to track higher again. The Federal Reserve will be very concerned because last time round they completely underestimated the power of such forces. So on this occasion, they're likely to err on the other side of the equation so as not to make the same mistake again. And they're going to be very keen to watch those sorts of price movements in global commodity prices. So I would suggest to you that this accompanying statement of this interest rate hike by the FOMC will be very robust in its nature in suggesting that they are actively maintaining a tightening bias, not just a rhetoric one, and that could spook markets. On top of this, we're going to see second quarter GDP slow substantially, perhaps down to around 1.6%, but that's Q2 data. Q3 for the United States might in fact be a non-event in terms of GDP. It could be very close to flat, making Q4 highly problematic. Remember, US consumer confidence at the moment, the level of happiness, if you like, and keenness to spend money among US consumers is still below COVID lockdown levels. So that's disastrous for any economic outlook. And yes, it may have ticked up here and there, but it's still at rock bottom crisis levels. Then we're going to have PCE data for the US. And if that core data remains strong, the Federal Reserve would even be tempted to suggest it will hike at the following meeting as well. It probably won't do that, but I'm trying to emphasize that this is going to be a very robust accompanying statement that the market may not be fully appreciating. We also have some major companies, participants in the Magnificent Seven, as I've heard them referred to, company reports coming out this week. The market's been so euphoric about these stocks. Remember, these 7 stocks are up about 58% this year, whereas the 493 stocks, the rest of the S&P 500 on average are only up 4%, which is more in tune with the harsh economic realities the United States faces. But this reporting this week also, given that expectations are so high, run the risk of being a buy the rumor, sell the fact event. But what if they actually disappoint? If they disappoint, we could be seeing the top. In fact, if you look at a Meta stock price, the daily chart, Meta is showing signs that it has already peaked. Apple is beginning to slide back. Now, some of these indices reported small positive gains on Friday, but what they actually did was again try to rally and have that rally rejected and closed on their lows. They exhibited very heavy intraday price action, even though, the end of day little billboard number was a little bit higher. And so there are warning signs here in this price action. And we have very big fundamental events this week. And this could actually be a watershed week that determines the outlook for equity markets for many weeks, if not months to come. So it's certainly a week to be paying attention to, and it's certainly a week to be active in managing your investment portfolio and your trading exposures. So I wish you all very well in that. May the markets be fair, even, kind. Have a great week. Thank you. Clifford Bennett, Chief Economist, ACY Securities.